Hello everyone, welcome to this webinar today from ESS BizGrants, ESS BizTools today, not government grants. My apologies for the delay. I hate to admit it, but I got mixed up with the new daylight saving. And so hopefully you can hear me. We are 5 minutes late starting. My apologies once again. Let's get on with it. Cash, a vital ingredient. This is an important webinar, and I hope that you can get a lot of benefit from our discussion today. Having sufficient cash in a business is vital for a business's overall performance. Cash is one of the 4 essential components of a business. And we need to have a good look at how cash can affect the business operations of a business. The other vital components are attracting and keeping the right people, and obviously having an outstanding leadership team. Also creating a differentiated strategy. It's important that your client's business is different to their competitors and fringe competitors even. And they need to execute what they've developed. So they need flawless execution. But today, let's look at the very important component of cash and the role that you as an accountant can play. It's a very important role because in these current economic conditions and banking conditions following the Royal Commission, it's fairly difficult to deal with banks, isn't it? You can assist in the scaling up process. A lot of your clients are thinking about scaling up. They're watching videos, they're reading books, they're listening to people like Andrew Geddes, who are talking about the opportunities. They may have read Vern Harnish's book, Scaling Up, which I would thoroughly recommend to each of you if you wish to gain a greater knowledge on scaling up. It also gives you the opportunity to supply your team with varied and interesting work that they can get involved in. I know you've still got to do tax returns in virtually every accountancy firm in Australia, although I do have one member of ESS BizTools who tells me that he's very keen to introduce a concept in a couple of years' time where they will be outsourcing their taxation returns, not the taxation advice, but the return work. So that's interesting. But this will give your team some challenging and interesting work because virtually every capital raising or cash raising assignment will be different. And it will help create some new income streams within your firm. Growing businesses need cash. Why? Well, if the turnover is going to be increased from $1 million to $3 million over the next couple of years, there's invariably an extra investment required in things like inventory, because they need to hold more stock. Work in progress, because they'll be doing bigger and more jobs, and there'll be investments getting made in them each week. I know they can raise progress claim invoices, but a lot of our clients somehow or other forget to do that and don't think raising that one invoice really contributes much. But when you put a whole stack of invoices, 20 or 30 of them together, it does mean something. And obviously debtors blow out. And if your clients aren't careful, the debtors' days outstanding will blow out. And whilst there might be some offsetting creditors, invariably debtors' balances are higher than creditors because creditors put strict demands on when payments have got to be made. Your client might also need money to fund a research and development project, and they can cost a fair bit of money. And sure, there's some tax offsets available, they come at the end of the year. And in the meantime, your client has had to fund this expenditure, which could be a few $100,000. And out of the R&D expenditure, of course, they may decide that they would like to get some patent applications made. And we all know that that can cost a fair bit of money. And then there's capital expenditure. Your client may have decided they need an extension to their factory or their warehouse or their office. And this is also going to be funded, and it's all part of the funding problem. So the funding problem is basically the working capital items of inventory, debtors, work in progress, and then research and development, patent applications, and capital expenditure. It can all be a very big drain on your client's cash availability. So where's the money going to, how do you forecast the amount of money that's going to be required? I think your client needs to be commissioning you to prepare budgets and cash flow forecasts for 3 years. So you can really look at how the money flow requirement is going to pan out over that period of time. And this will highlight the shortfalls in cash. And you then need to sit down and have a very frank discussion with your client, a realistic discussion as to where that money is going to come from. Now, let's look at some of the funding sources. Obviously, internally generated funds from activities the client's already conducting and some of the new ones. But you need to be realistic in those estimates and obviously take taxation into account. So the client may have some money internally. It could be a new capital contribution by the current owners or shareholders in the business. But are they willing to invest more money at this stage? And will they be able to invest all that's required? They might be able to invest part of it, of course. The shortfall may be $700,000. The owners may be prepared to invest $100,000, still a shortfall of $600,000. They could look at getting loans from their banks or financiers, but most loans require security. Have they got spare security that they're going to be able to offer to their bank or financier? Or do they have personal assets, or do relatives or friends have personal assets that they're prepared to offer as security for the company? These discussions need to be held so that there's a realistic conclusion reached as to how much money the company, the business owners, shareholders, friends and relatives might be able to contribute. You might have debtors finance, of course. Means dealing with the bank again, but debtors can be an asset sitting in the balance sheet that is not being utilized to secure funding, so it could be looked at, or inventory financing. And last but not least, we come to capital raising. Now, this is a new area for a significant number of small businesses in Australia, because most small businesses have not historically thought about raising capital from the public. One source has been available for 35 years, and that's Section 708 of the Corporations Act. Yeah, it was introduced 35 years ago, and for a long time it was virtually there on its own. 2.5 years ago, early stage innovation company capital raising was introduced into the Australian corporate landscape. And it's a great help for a young company that's developed a new product, process, or service. We're going to talk a little bit more about each of these items in a moment. And crowdsource funding equity raising, which is about to celebrate its first year, first 12 months that it's been available for small businesses, which is on the 19th of October, next Saturday. It's 12 months since crowdsource funding became legal for small companies. So let's look at the Section 708 capital raising. If you're familiar with this, my apologies. Please look at this as a refresher. But if you're not familiar, please understand that this was traditionally the only way that private companies could raise any sort of capital. And I've been involved in quite a number of capital raisings utilising Section 708. Until very recently, it was all that we had to raise money for private companies. So under Section 708, a private company can raise up to $2 million in a 12-month period from a maximum of 20 investors. And what you need to be aware of is that it's a private company, so there is a 50 shareholder limit. So if at the start of the year you had 40 shareholders, obviously you can only have 10 new shareholders. Some of the original 40 can contribute for more capital, but you can't get 20 new ones because you're going to exceed the 50 shareholder limit. So Section 708 can have its limitations, and the maximum amount of money that can be raised is $2 million. But it comes in handy. As I said, I've been involved with quite a number of capital raises using that section. When I think about it, probably 50 or 60 of them. And it's always a multiplier. You say, well, we need to raise $1 million and we can only get it from 20 investors. So the minimum investment we're looking for is $50,000 each. It's made easy, of course, if someone comes in and offers 500,000, that changes the numbers. But you've got to be very much aware of your numbers when you're trying to use Section 708. Let's look at the early stage innovation company as another activity that you might consider. The company must be under 3 years of age. So this is a government initiative to attract investors to young companies who have developed a new product, process, service, marketing, or management technology. Expenditure in the last 12 months must be less than $1 million. And income must be less than $200,000. But if you happen to have received an accelerating commercialization grant, or your client has, that's not included in that $200,000 figure. And they must satisfy some tests to be classified as an early stage innovation company. The first test is the provisional test, and that basically is the items I've listed above. Income under $200,000, expenditure under $1 million, not registered on a stock exchange, under 3 years of age. We then go to the next set of tests, if you pass the first lot, called the gateway test. Now, the gateway test has got about 8 separate items, and you earn points. Points vary depending on the particular item, and you have to achieve at least 100 points if the company is going to be classified as an early stage innovation company. So you earn tests for if the company has undertaken a significant amount of research and development. So if more than 50% of the company's expenditure was on research and development, you earn 70 points. If the expenditure was on research and development was under 50%, but over 20%, you earn 50 points. So you're trying to get 100 points. If the company has been admitted to the Accelerating Commercialization Grant Program, the company earns 70 points. If the company has already raised $50,000 in shareholder investment from arm's length in external investors, the company earns 50 points. If the company has registered patents or registered designs and things of that nature, the company can earn 25 points. And so it goes on. So if you can accumulate 100 points, you satisfy the gateway test, and on the basis you've already passed the provisional test, that company is able to be classified as a early stage innovation company. If you don't pass the gateway test, and a lot of very new companies will not pass that, You then have to go into the principles-based test. Now, this test asks 5 key questions that requires an answer with some detail attached to it. So it's not a one-line answer, yes, no. The tax office and Oz Industry are looking for some detailed information. And they want to know whether the company is genuinely focused on commercializing this product, process, or service that has been developed. Has this product got high growth potential is the second question. The third question is, can the company scale this business? So can it be made bigger than what it currently is to go to more markets, preferably around the world? And will the product appeal to broader than the local market? And has the product got competitive advantages? Now, a lot of those questions are a bit similar, and many of your clients, if they want to utilize these questions, will need to be retaining some external consultants who can help them prepare answers to some of those questions. Now, the company itself doesn't receive any other benefits other than they're potentially at the top of the list to raise investment from knowledgeable investors, because investors can be eligible for some things. So this was introduced by the Turnbull government in December 2015 as part of the government's innovation program to encourage investors to have a good look at young, innovative Australian companies who had developed something that was new and looked fairly exciting, but lacked capital to be able to take it to the market. So the investor can obtain a 20% tax offset on the value of their investment, subject to a retail investor not investing more than $50,000. So the offset can be $10,000. And a sophisticated investor can obtain a rebate of up to $200,000 off their tax on investments up to $1 million. Now, they can invest more than $1 million, but the 20% tax offset runs out at $200,000. So obviously that's been calculated on $1 million investment. So that's something for investors, something as an inducement. And the other big inducement is that if the investors retain these shares in this company, the original shares that have been allocated to them as part of this being deemed to be an early stage innovation company, they are not eligible for any capital gains tax if they hold those shares for longer than 12 months and less than 10 years. At the end of 10 years, the company is revalued, and that gives a new cost price for capital gains tax purposes for those original shareholders if they are still shareholders in the company. So that's the benefit for early stage innovation companies. Please think about it whenever you're dealing with people who have got young companies. They mightn't be young. In fact, a couple of the people I've worked with were definitely not young. They were people well into their 70s who had developed a new product. Something one guy told me he'd been thinking about for 25 years. And it's now out in the market. So they're not all going to be young people, although I suspect the majority might be on the younger side. But the company will be young. And then we turn to crowdsource funding equity raising. The private companies are now eligible. When crowdsource funding equity raising first started about 18 months ago, you had to be an unlisted public company to utilize the opportunity to raise capital. The government realized that the market didn't support that and quickly moved to change the legislation so that a private company is able to utilize crowdsource funding equity raising. And it's brought Australia into line with the other major countries in the Western economies, UK, USA, Canada, various countries in Europe and New Zealand. All have had crowdsource funding equity raising for private companies for 7 to 8 years. And finally, Australia's finally getting into the action. In the United Kingdom, this is now a very significant way that smaller companies finance their businesses. And I expect the same is going to happen in Australia. And there is a tremendous opportunity for accountants to own this space, to be the go-to person, the real trusted advisor, to help your clients really sort out this issue. So let's look at what the requirements are. Group turnover under $25 million in the previous 12 months. Group asset value under $25 million. That's a coincidence that $25 million is mentioned in both instances. Not listed on a stock exchange anywhere in the world. And that company can raise up to $5 million in a 12-month period, as long as it goes through the process. And if it wishes and it reproduces the documentation that's required, they can do the same the following year, as long as the market supports them, of course. And that's the caveat that I'd put on the first comment. They can raise $5 million in 12 months, as long as the market supports them. I've seen a capital raise of only $60,000. There's been quite a number in the vicinity of 300,000 to 500,000. So you can pitch the deal to suit what your client's requirements are. And some of the companies are raising an initial tranche of money, going out and doing what they said they would do with that in their offer document, and then going back later in the same year, because you can raise up to $5 million in the year, and raising some more money. One of the companies which has raised the full $5 million was a digital bank. It raised $2.4 million in their first tranche of capital raising, and then raised $2.6 million in the second capital raising, all within 12 months. This legislation has introduced a new terminology for Australian corporate law called an intermediary, and the full name is a crowdsourced funding intermediary. There's 15 of these organisations that have been appointed by the Australian Security Investment Commission, and these people act as the gatekeepers, but also the promoters. Gatekeepers to make sure that the legislation's been abided by and to report back to ASIC. The promoters, because they wear another hat, which is that they are going to go to the marketplace, basically to the marketplace that they have already established, because they have gone to the market and have gained the names and email addresses, telephone numbers, etc., of thousands of people who have said to them they're interested in looking at the latest investment opportunities. The intermediaries claim that they have somewhere between 25,000 and 50,000 of these people on their books. One intermediary has 120,000 people on their books, they claim. So that's an interesting, so you need to appoint an intermediary, and in our material, we'll guide you through the process of how you introduce the concept of intermediaries and what they can do, what their powers and responsibilities are to your clients. So we've got all that covered for you. The next thing is that there needs to be a prospectus type document prepared, which is called a crowdsourced funding offer document. It's not as expensive as a prospectus, but it's there and has to be prepared. And this is the key document that the intermediary has to read and approve. And when they have done that, they will upload the details on your client's company onto their website to be able to raise the capital, and they can do that over a 90-day period. So what documents are required as part of this capital raising process? I think companies or businesses generally who are trying to raise money are going to need a business plan that looks at what the director's vision is for the next 3 years. Where's this company going to go? What's it going to do? Budgets and cash flow forecasts, of course, for the 3-year period. They'll need a memorandum of information or an offer information statement. You'd have a memorandum of information prepared for Section 708 capital raising. An awareness of corporate governance matters. I think that's very important. And proactive firms, accountancy firms that are available there to assist them. They need assistance. This is the challenge for you. Are you going to be prepared to give this? Or are you going to refer it to someone else? The big risk is that if you are not proactive in this space, a client who hears about these opportunities could well go off and talk to someone else who may not be an accountant, but that firm may well have a close association with an accountant, and you may find that your client has been encouraged to switch their accounting stroke tax work to someone else. Isn't it far better for you to be proactive, analysing your clients, and we have a form which will assist you to do this, to determine who might be interested in some of these capital raising exercises, and then to decide whether you are able to offer those services, and if you are not, that you could refer them to someone else. And if you want to know who else you can refer them to, please contact me. And we do some of that work ourselves through our own consultancy business, which does not do taxation work. Or we can refer you to someone in your area or outside your area, but who you are happy to refer your client to, on the understanding that they will not do anything which will interfere with your traditional relationship with your client for the preparation of annual accounts and taxation returns. Looking at the ongoing services required, a lot of these companies, when they raise capital, are going to need the services for part of each month, I think probably each week, of a virtual chief financial officer, because they're going to have boards of directors, which hopefully are going to have some external directors on them, who are going to be looking for financial data and information. And these companies are wanting to grow. So they should be encouraged to put in a first-class accounting reporting system so that board of directors meetings can be held monthly. Leadership team meetings can be held weekly and monthly, so that there is a continuous flow of information. I think they're going to need your assistance. Not many of them are going to want to pay out the money that a full-time, competent chief financial officer is going to cost them, but a lot of them are prepared to fund a switched-on accounting firm who is proactive in supplying these services. And with today's technology, you should be able to do it. You're not going to have to be in situ at your client's office all the time. And there's also, for your audit teams, the possibility of audit appointments. So you might miss out on the virtual CFO type appointment, but there is audit requirements. Some of the companies raising capital under Section 708 will have an agreement with their shareholders that an auditor is going to be appointed. And if a crowdsourced funding equity raising company has raised more than $3 million from the public, whether it's crowdsourced funding, capital raising, or Section 708 capital raising, once it's that aggregate figure exceeds $3 million, the company is required to appoint an auditor. So it's something to think about. That might be what you get out of today's workshop, going out and trying to find companies that are going down this path to present your firm to them as a potential auditor. So how can we help you at ESS BIZTOOLS? We've been writing this material for 20 years on all sorts of matters to help accountants offer a broader range of professional services, business improvement services. I started writing this after becoming acquainted with Financial Management Research Centre at the University of New England, which was run by Andrew Geddes, who many of you know as one of the most well-known and outstanding accounting trainers, mentors, coaches in Australia. And I thought there was a need to develop some products and services that accountants could actually utilize without having to sit down and write your own. So with Andrew's encouragement and Andrew Geddes' support over the years, and I'm still very closely involved with Andrew Geddes, and in fact on our website there are about 6 video recordings of interviews that I've conducted with him over the last 4 or 5 months on a number of matters, primarily crowdsourced funding issues. So please go there and have a look. So we got product packages, which will assist you on Section 708 on early stage innovation company crowdsource funding. You don't have to reinvent the wheel. We've done the hard yakka. We've prepared it for you. We've given you lists. We've given you suggested correspondence with clients and prospects. We've prepared seminars that you can present. All you've got to do is read the material and start presenting it. And there's 23 product packages on a range of matters: Chief Financial Officer services, succession planning, debtors management, personal property securities register, all prepared the same way. They've been prepared to assist you to offer these sorts of advanced services without having to spend hundreds of hours on writing the material yourself. And if you work out the cost of hundreds of hours at partner rates in preparing material, and in fact, I think it would cost more than a few hundred hours, probably at least a year's work, if not more, for a partner to produce what we have within ESS BIZTOOLS, because it's taken us a long time to prepare it all. So these products are ready for you to start using straight away and start earning fee. You'll be able to earn diversified fees. I'm out of the day-to-day accountancy industry at present, of course, but what I hear and what I observe, things are becoming tougher, and various experts, the Commonwealth Bank's reports on accounting, a whole lot of them are really predicting there's going to be a very big crunch in about 4.5 years' time. Where's your firm going to be at that stage? Those firms who are just left with doing taxation work, total compliance work, so-called expert after expert are forecasting that you're going to have some problems. Now, they might be wrong, but I doubt it. And I'm not saying that you abandon tax work. No one's suggesting that at all. I know how important it is as a cash flow generator. But why not hedge your bets? Why not aim to have at least 30 to 40% coming from business improvement services, non-compliance work, the sort of things we're talking about today. So you're invited to visit our website, www.essbiztools.com.au, where you can look at what's available within our gold package, which is our leading package, which includes everything we produce, or the silver package, which is basically the same, except you do not have access to our grant program, nor do you have the ability to reproduce all of our articles on your website. And you can read the 23 learn mores that we've developed for each of the individual product packages. So you can have a good look at that. And you can complete the form to ask us to present a webinar to you on a one-on-one basis for your firm. If you have any questions, please send me an email. And geez, I've been amiss with starting late and everything. I forgot to check the questions. I'll just check the questions. I can't see that there's any questions. If you think of any questions later on that you'd like to ask me, please send me an email, peter@essbiztools.com.au, and I will get back to you. Or send me or ring me on your telephones, 1-800-232-088, and I'll be happy to talk to you and give you a better insight into the way that I would recommend that you approach this whole question of assisting your clients to generate sufficient cash to be able to run an outstanding business in the future. Thank you for participating in this webinar today. Have a great day. Goodbye.